और बेटा कैसा है?
एकदम बढ़िया भैया।
तो देख अब कंटिन्यू करते हैं. इन अर्लियर सेशन we were discussing about money market instrument, and then I talked about various money market instrument. Also talked about liquid bees.
Yes.
Liquid bees which I used as liquid funds to keep my funds for trading. So liquid bees is basically an ETF. So now we'll move on to ETF. Earlier we were talking that we'll be discussing about mutual funds, but let's go to ETFs first. Okay. So I have
Okay.
already found some resources for you to explain you about ETFs. So without wasting any time, we will straight go to screen sharing, and I'll share this basics of investing. Okay, basics of ETF. So here I go to Association of Mutual Fund of India (AMFI) official website, and please read it for me. What they say. What is an
Yes.
ETF?
An ETF or exchange traded fund is a marketable securities that tracks and index a commodity bonds or a basket of assets like an index fund. In the simple terms, ETFs are the funds that track indexes such as CNX Nifty or BSE Sensex, etc. When you buy shares of an ETF, you are buying shares of a portfolio that tracks the yield and return of its native index. The main difference between ETFs and other type of index fund is the ETFs don't try to outperform their corresponding index, but simply replicate the performance of the index. They don't try to beat the market, they try to beat the market. Unlike regular mutual fund, okay.
See, basic difference they have written so well that ETFs are basically an enabling instrument. Earlier we have also discussed ETF that I want to employ my money in
Different stocks.
Nifty 50 stocks. Then how do I do it? Do I go and buy one stock of each 50 stock? Then how do I
No.
decide the ratio? We discussed it in detail.
Yeah, by
So
buying Niftybees.
an ETF will create a portfolio of those 50 stocks. And now even with 10,000 rupees, 50,000 rupees, you can go and buy that ETF. And now you know that you have bought all 50 stocks in that particular proportion. So such requirements can be for different instruments. So let's see how ETF is enabling. ETF is not trying to beat Nifty 50. A blue chip mutual fund might be trying to beat Nifty and generate some alpha.
Yes.
But here what we are doing, here we are trying to kind of give an instrument which enables you to invest. So unlike regular mutual fund, ETF trades like common stock on a stock exchange. So, this is another difference. You cannot enter and exit mutual funds on exchange platforms. But with most ETFs, they can be traded like an individual stock. The traded price of an ETF changes throughout the day like any other stock. So the prices keep on going up and down. The trading value of an ETF is based on net asset value of the underlying stock that an ETF represents. ETFs typically have higher daily liquidity and lower fees than mutual fund schemes, making them an attractive alternate for. Okay, now the second important aspect of ETF is lower fees. Why lower fees? Because mutual funds claim that they are applying more effort, more brains into beating markets. They are applying more analysis, more effort, more brains into beating markets. But with ETFs is what doing? ETF is necessarily enabling instrument. So they are basically creating a portfolio which do not require active management, which is not require active analysis as such as compared to mutual funds. So they are ready to work at a lesser amount of fees. They are ready to work at a lesser amount of fees, because if they are charging higher fees, then ETF will become impractical also. So they are ready to provide ETFs at a lower fees. Okay. So these are the 2-3 different factors that they are traded on exchanges. They are not trying to beat the markets, and they generally attract lower amount of management fees as compared to mutual funds. Passive management, ETFs are passively managed, that I just said. The purpose of ETFs is to match a particular market index, leading to a mutual fund management style known as passive management. Passive management is the chief distinguished feature of the ETFs, and it brings a number of advantages to investor in index fund. Essentially, passive management means our fund managers make only minor periodic adjustment to keep the fund with the index. An investor in an ETF do not want fund managers to manage their money, decide which stocks to buy, sell, or hold, but simply want to return the mimic those for the benchmark index. I told you this already covered. ETFs are cost efficient, that we just discussed. Okay. What are the cost of investing in ETF? While expense ratio on ETF, there are certain costs that are ETF are broad traded stock exchange. Every time an investor makes a purchase or sale, he should pay profit. So since we are investing into ETFs through exchange platforms, let's say I'm buying certain ETFs which are listed on NSE. So then when I'm buying and selling, I am charged a brokerage fees. But I am told and I am aware that certain brokers are charging a very low amount of brokerages on ETF products. So not only the management fees is lower, but the transaction cost of in and out of ETFs is also lower. But the government, STT, etc. are also there. Flexibility of ETFs. ETF share trade exactly like stocks, unlike index stocks, which are priced only for market closing. ETFs are priced and traded continuously throughout the trading day. They can be through our margin, sold short or held in the long term exactly like commons. Yet, because of their value is based on underlying index, ETFs enjoy the additional benefit of broader diversification than share in single company. But one thing they are not saying is that the ETF prices are not always liquid. So when you are buying and selling, that you might have to see a difference between, which is called spread between best bid and ask. So bid ask spread is also the cost that you have to pay, because all ETFs are not very liquid and the amount of transaction that is happening every day is not very high. So that is one limitation that ETFs have. Are ETFs only for stocks? No, ETFs can be for anything. ETFs can be for bonds, real estate, commodities, currencies, and mutual funds. Partly we have discussed it. I have already told you about Indexbees, Niftybees, Bankbees, and then there can be ETFs for real estate. Gold ETFs we have already discussed that they keep physical gold and then they issue. So now you can buy gold worth rupees 5,000, which you can never go and buy from jeweler probably. So multi-asset funds and all, different things. For anything you can practically create ETF. So basically what these finance professionals do, wherever they see that there is there can be an opportunity, in terms that there is a demand for certain kind of investment, there is a demand for certain kind of investment and they can attract money, they will try to create an ETF around it, because market is full of innovators and creative thinkers. So they will offer a product if they see some kind of demand coming, and if there are people who are ready to apply for those ETFs. Then let's say an ETF has a fund under management of 1,000 crores. An ETF gets a fund of 1,000 crores under their management, and they are charging a fee of 0.5%, 0.5% annually. Then even that 0.5% is 5 crore rupees. Even that 0.5% is 5 crore rupees at the end of the year. So this is why the financial market or the financial domain itself is very lucrative in terms of money. And that is also, I did my MBA in finance thinking that I'll make big money out of. So ETFs can either be purchased on the exchange or directly from the fund. The fund creates redeems units only in predefined lot sizes in exchange for a underlying portfolio. So you can go to the fund as well, but mostly for liquid ETFs, exchange trading them on exchange is best. ETFs have a very transparent portfolio holding. You can read it later for yourself. How do ETFs drive their liquidity? ETFs drive the liquidity first from trading of the units in secondary market, and secondary to the in-kind creation redemption process with the fund is creation unit size. What is the difference between ETF and index fund? Read it for me, please.
Yeah. While both are passively managed, the biggest difference is that index fund operate in the way all mutual funds do, in that they are priced at the close of trading day based on the NAV of the underlying securities, whereas ETFs are priced to the market throughout the trading day. That means they are easier to buy and sell quickly, if need be. Secondly, ETFs are available only on stock exchanges, hence, you need a demat account to invest in an ETF, whereas for an index fund, you don't need a demat account, and you may buy or sell the units of an index fund directly from the mutual fund in small amounts.
All right. So basically, they are very similar, but index funds are leaning more towards mutual fund. Index funds are leaning more towards mutual fund, and ETFs are leaning more towards a stock. So that's the difference. But the common factor is that they are both passively managed, and the management fees for both these ETFs as well as index funds is low. So that these are some common factors. Dividends received by an ETFs are typically reinvested in the funds. What happens with the constitution underlying index change? Constitution of the index, like say somebody is having Nifty ETF, which mimics Nifty 50 stock, and some some share goes in and out. Once securities underlying index are changed, the fund can change the securities underlying portfolio by selling the securities that are being removed from the index and including those that are, like I am hearing that presently they are going to include Mindtree or something, some IT stock they are
Yeah.
going to include in Nifty 50. So some ETFs can actually buy the stock that is going out and include the stocks that is coming in. So they can buy and sell in the physical market and manage that. Tracking error is the difference between the ETF's portfolio error and the benchmark or index it was meant to mimic or beat. So tracking error is basically that you cannot track it 100%. You are trying to mimic. You are trying to, let's say Nifty 50, Nifty ETF. Nifty ETF is trying to mimic Nifty 50 index. But at the same time, it is not 100% possible. It is not 100% possible because index is calculated with a methodology. But can we, market is trading throughout the day. Can we buy at exact prices through which the index is calculated? Same methodology. Can we buy, like index is calculated based on the last 30 minutes of closing price? But as a buyer, do I need to wait for that averaging of 3 to 30? No, I'll be buying it throughout the day. So sometime I'll be buying higher than the index price, sometimes or the closing price. Sometimes I will be buying higher than the closing price. Sometimes I'll be buying lower than the closing price. So my cost of buying and my prices of selling might be sometimes higher or lower than the actual index. Sometimes there might be slight differences in the amount or the proportion or the percentage that I'm buying the constituents. There might be slight ups and downs. So that will create some tracking error. So although ETFs will be very, very close to the actual benchmark, but sometimes there can be some variations due to execution things. Not errors, but you can say execution limitations will create some kind of gap between the actual benchmark and the ETF, and that is called tracking error. Basically, you can say it is tracking difference rather than any kind of error on anybody's part. So, what are the benefits of investing in ETFs? Managing assets allocation can be difficult for different investors given the cost and assets required. Cash utilization, investor typically seek exposure to equity market but often need time to make investment decision. ETFs provide a parking place for cash that is designated for equity investment. Say what happens, somebody, let's take for my example. Let's say I am having 100 lakhs of amount that I am looking to invest in some kind of share, but I am looking that the market is high valued, and I will invest it later, maybe when the market retraces from its top. But I have the money, so what I do for the time being, I invest them in some kind of gold ETFs, or I invest them into Liquidbees or something like that. So once that I invest in those kind of ETFs, my money is parked. They are already generating me some returns, and now that 100 lakhs I won't be liquidating at the same time. Let's say I decide that okay, in month of August I'll be investing 5 lakhs. So I take out 5 lakhs from those ETFs because they are very liquid. So I can take out 5 lakh easily and invest them in my designed stock portfolio or whatever. So this way I can plan my investing and keep my extra cash into ETFs. I can buy different kind of ETFs. I can buy gold ETF, stock ETF, Nifty ETFs, and all these stuff, and I can diversify all my investing to ETF as well. ETFs are an excellent hedge vehicle because they can be borrowed and can be sold short. The smaller denomination in which ETFs trade relative to most derivative contracts provide a more accurate. So they can be sold short intraday, but they are not available in F&O. And arbitrage, they can do arbitrage because there is some kind of tracking error. So somebody is seeing that the market might go up and down. So they can trade between, let's say for Nifty ETFs, they can trade between Nifty ETFs and Nifty futures, something like that. So given an opportunity, if there is some gap in the market, they can create such. So now we'll see what are the different kinds of ETFs that are available in the Indian market. Okay, ready?
Okay. Okay.
So check this. Check it yourself. Read it for
What
me,
is
son.
this?
Read
Yeah,
it out.
Kotak Nifty MNC ETF, Sharia, ICICI Prudential Nifty PSU Bank ETF, Nifty PSU Bank, Nifty Midcap 50 Index, BSE Sensex Index, Nifty Auto Index, Nifty Auto TRI, HDFC Nifty 50 Value 20 ETF, HDFC Nifty 100 Low Volatility 30 ETF, S&P 500 Top 50 Total Return Index, Sensex Gold, Nifty PSU Bank, and Nifty SDL APR 2026 Top 20 Equal Weight Index, Nifty 50 GSEC 10. There are so many. Where which is most famous and
Nifty Liquid, ICICI Liquid. These are example of some liquid ETFs. Then there are gold ETFs. Then there are government security ETFs. As we were discussing, ETFs can be created around anything typically. There are
yes.
several agencies which are providing gold ETFs. There are several agencies which are providing Nifty ETFs. There are several agencies which are providing some bond market ETFs or something like that. You can see that the Kotaks and the ICICs, etc., they are all providing different kind of ETFs. So obviously, when they provide ETFs, they charge a small management fees, and that is the earnings. That is why these financial institutions keep on issuing such ETFs. So,
Which ETF
so
has
there
the
are
most volume, Bhaiya?
there are sorry, come again.
Which ETF has most volume, most traded ETF, which is the most popular?
Here you can see like this. See, this is
Yeah.
silver bees. So
Okay.
apart from gold, one can also invest in silver. They will keep silver, physical silver, and issue. So silver bees has good volume.
Mm-hmm.
Physical. This is so here you can track volumes. Nifty bees is the probably the most liquid.
Okay.
Nifty bees probably the most liquid. Nearly 70 crores of volume traded in a particular day. And then there are various others, this which is pharma
Nifty
bees.
Pharma.
So pharma bees is basically investing in a portfolio of pharma stocks.
Pharma shares.
Somebody who pharma stocks, yeah. And then liquid bees, which I was talking, liquid bees is
Okay.
highly liquid. You can invest any amount of money. And liquid bees is an interesting concept. I want you to read it. This is the homework I am given you. The price of
Okay.
liquid bees is always 999. It is always trading at 1000 rupees. So how it happens, we'll discuss this. So So this is how it is. So Indian scenario, there are a lot of ETFs, and many of them are very liquid as well. So when investing, you can liquid bees is
Mm,
obviously the
most
see underlying asset they also mentioned. Liquid bees invest in government
governments.
securities, Nifty 50s, rate index, Nifty 50, many Nifty IT, means information technology stocks, silver, pharma stocks. This is government bonds,
Yes. Gold bees are also there.
and then like with through this Mon 100, you can also invest in Nasdaq. So if you are upbeat about IT stocks and this what you call Facebook, Apple, Facebook, I mean Meta stock, etc., going up, you can bet on Nasdaq 100, etc. So there are ETFs for mid cap market. So pretty much anything that you can imagine for investing, that is provided by ETFs, because this is how capital markets function. That you see some demand for something and then you find the product. So this is how it is. So this is all about ETFs. You go through it. If you have any doubts, post it for me. I'll be happy to reply to you.
Okay.
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 So we will stop the ETF part here. In our next session, we'll go to mutual funds. Okay.
Okay.
Okay. Okay.
Okay.
Bye.
Bye.